We start the market talk right now. One of the great things to learn is the value of extreme objectivity. We have a lot of biases and subjective views on stocks and sectors, and which we tend to ignore, and then we tend to ignore any new views, oblique ideas, or any change in circumstances. It's a totally disruptive world out there where the incumbent beliefs are challenged regularly. The permanent knowledge which we should have is principles and frameworks that help to make sense of the information which is constantly expiring. Paying attention to people who disagree with us is very important. The market setup, as I see it, the turning point in Indo US relations, with a flurry of agreements being signed in semiconductors, defense production, technology, and space flights, would be good for the industrial sector in India. There is no partner more important to India for its future than the US. Clean energy, semiconductors, AI, biotech are all the fields in which a lot of progress would be made in future. Regarding the IT sector, Accenture's Q3 results and guidance is devoid of any spark and the order booking is soft. The full year guidance from Accenture has been lowered, and in addition, the generative AI is likely to usher in unprecedented disruption and transformation of business model. The IT industry has to adjust to generative AI. Most enterprises are adjusting to slow down by cutting smaller deals while continuing with their large transformational projects. So, if the smaller deals are going to be less, then it may affect the revenues and margins of the IT companies. The revenue growth guidance of Accenture has been lowered to 8 to 9%, and the operating margins are expected to be also lower. So the Q1 of FY24 for Indian IT industry is expected to be not much better than Q4 of the last financial year. Few savvy mid-sized companies may still have an edge. Government infrastructure capex is likely to remain very strong, and PNC infrastructure would be a beneficiary of that. It has guided to a strong order inflow in the current fiscal, which coupled with its healthy order book brightens its growth outlook. PNC remains a preferred bet in the construction space. It is likely to do some asset monetization, which will deleverage its balance sheet. It is trading at a PE of 9 for FY25 expected earnings, and it is speaking to venture funds like KKR to divest 12 road projects. It has given a revenue guidance of approximately 15% for the next financial year. The other stock which is likely to do well is PI Industries. It has high exposure to custom synthesis business, which is insulating it from pricing pressures. It is expected that it is likely to have 18 to 20% revenue growth in this financial year. Three-fourths of its revenues are from customer synthesis, where they supply products to innovators. Though the stock is expensive at 35 times FY24 earnings, but in a tough agrochemical market, PI's focus on relationship with innovator companies and patented products is insulating it from pricing pressures. If BOB, that is Bank of Baroda, can deliver a return on assets of over 1% for FY24 and beyond on back of loan growth and reduced bad loans, it will be assigned higher valuation multiples. The good part about Bank of Baroda is that it does little hiring for its top bosses and other managements, and along with aggression on technology, this stock is likely to do well in future. The balance sheet has improved, The stressed loans have reduced. The book value is approximately 203 rupees. So it is right now trailing at below book value, that is at price to book of 0.95. Just for reference, HDFC Bank is at 3.69 price to book and has a return on assets of 2.17. So Bank of Baroda has a long way to go, and in case the performance improves, its price can also improve substantially. The big news is that the China steel output fell by 7.3% in May year on year, and the output declined by 2.7% sequentially. State of its steel industry shows the severity of slowdown in economic conditions. Even though India's steel consumption growth is steady due to revival in automotive, real estate, and construction sectors. Steel prices, coking coal prices, iron ore prices are falling, so this sector needs to be watched carefully. I have found that Indian investors are getting bolder by investing in small caps and small cap stocks and small cap mutual funds. Recently, Motilal Oswal has launched a Nifty Microcap 250 index fund. Why is it so? Because market is searching for new ideas because it finds that the older ideas and established names are very well researched and fully priced. Though the risk in small caps is in liquidity, and there is a problem of exit in case the stock price falls, because the exits are always with deep losses. So the interest in small caps and mid caps is a thing to be watched for future. Now the stock I'm going to cover today is Navin Fluorine. It operates one of the largest integrated fluorochemical complexes in India with a presence in specialty chemicals, CDMO, and high performance products, that is refrigerants and inorganic fluorides. It has two manufacturing facilities in Surat and Devas, while it is setting up new greenfield project at Dahej. In terms of revenue contributions, out of its three businesses, specialty chemicals, CDMO, and high performance products, specialty chemicals constitute 36%, CDMO 22%, and rest are from high performance products, that is 42%, consist of refrigerants and inorganic fluorides. Now, in the recent performance of this stock, Q4 FY23, strong growth was observed across all segments led by capacity ramp up and better product mix. The high value business where there is high margins are specialty chemicals and CDMO. CDMO is contract development and manufacturing organization. Revenues were up 65% year on year to 407 crore, led by strong growth in CRAM segment with stability in the specialty chemical segment. The revenue from specialty chemical was up 28% year on year to 204 crore, while the same from CDMO increased by 131% to 203 crores. So both these segments are doing well. Its legacy business revenue increased 91% year on year to 289 crore, driven by commissioning of hydrofluoroolefins and better realization of refrigerant gases. So all segments of this stock company are doing well. Now let's see the financial summary. The over the period of last 5 years, if you see the revenues are constantly improving and have nearly doubled with a CAGR of roughly 17.9%. EBITDA has also become 2.5 times with a CAGR of 20.7%. Profit after tax has grown by roughly 15.9% CAGR. The ROE is improving and the PE has been going down, so the stock is becoming cheaper and it is likely, presently it is trading at 35 times next year next year projected earnings. It is likely to grow at 16.5% at least for the next 2 years, and with an EBITDA growth of 20.9% and a profit growth of 22.1%. You see the chart of this stock. It is currently the prices have come down between 50 DMA and 200 DMA. 200 DMA is approximately 4350 and it's an attractive buy at those levels. Seeing the key ratios with the expected EPS of 135.5 for FY25 and a book value of 622.5 and a dividends likely to be 27.2. The gross margins are expected to be stable to 57%. EBITDA margins are likely to improve to 28%. Profit after tax to approximately 18.6%. Debtor days are reducing. Inventory days are also reducing. Creditor days have gone down and cash conversion cycle has improved. Return on assets has also improved. ROE and ROC are also improving every year. The solvency, that is debt to equity, is better and interest coverage ratio is under control. Valuation wise, the PE of the stock is falling, which makes the stock very attractive. So in this stock, the specialty chemical sector continues to deliver strong performance driven by strong partnership and technology platforms. CDMO business is on a strong footing and the management expects further capacity expansion in the business. Hence, at an expected target price of 5160 per share, that is 38 times expected FY25 earnings of 135.5, the 135.8, the stock can be bought at present levels. Now talking about interplay of option Greeks, in the last few sessions we have discussed about all the option Greeks separately and how they impact the option pricing. So let's now today discuss the interrelationship of option Greeks. For an option trader, every aspect is changing regularly. All of them are changing at once. So all option Greeks are impacting him simultaneously. So the underlying price could be trending while volatility is rising and of course the time keeps passing. So there is a time decay while the time value keeps going down. So just to recapitulate, delta drives the option premium with movement in the underlying prices. Gamma drives the delta. Theta drives time-based erosion of option premium and vega drives the volatility of option prices. There is another Greek called rho which drives option prices with interest rates. So let's see what are the interplay of these Greeks. Volatility is lowest for ATM options, at the money options. The volatility smile refers to the smile shaped curve of volatility against the strike price. Options buyers would be better off buying at the money options as their low volatility keeps the premium low, thereby allowing for higher returns on investment. By the same logic, options sellers won't get much returns by selling at the money options. So, option buyers are better off buying at the money options due to low volatility because the premiums are lower and then they expect the volatility to go up, leading to higher returns on investment. It is totally opposite for option sellers. When there is more time left to expiry, there is more time for things to go wrong. So option sellers who are taking higher risk, get higher premiums and have to be more sensitive to volatility of prices. Longer the time to expiry, higher is the vega. So longer expiry options trade at higher premium due to dual impact of vega and theta. We can just see it with an example of Nifty call option will strike at 19,000 expiring next week as compared to the one which is expiring next month. So the one which is expiring next week will have lower premium and implied volatility as compared to the one which is expiring next month. Due to longer time to expiry for next month option and also because of higher implied volatility in longer expiry options. We can see that with an example. This is the option chain of Nifty option expiring next week. Here if you see for 19,000 call, the option premium is 6.9 and the IB is 8.68. Now for same 19,000 call for July end expiry, the option premium is higher to 148.9 and implied volatility is also higher. Now another factor to look at is the delta factor. Delta measures the rate of change of option price for a unit change in underlying price, and gamma measures the rate of change of delta for a unit change in the underlying price. Delta moves with the strike price of options. It does not have a constant rate of change. The delta moves slower for in the money and out of the money options and faster for the at the money options. An increase in volatility increases delta and keep option premiums from correcting materially. So even if the option option price and options are moving in directions which are favorable to you, the option premiums may not go down materially due to increase in volatility. For an OTM option, even if the underlying has moved favorably, still the option premium may not correct enough. At that time, we should check the volatility. Option sellers would like to sell when volatility is high in order to pocket a high premium, then wish for volatility to fall so that both falling volatility and the passage of time work in sync to make the option expire worthless. Delta can also be interpreted as the probability of an option expiring in the money. ATM options have a delta of 0.5 because they are right in the middle and have 50-50 chance of expiring in the money. This steep rise in volatility around at the money option at expiry makes their premium extremely sensitive to underlying spot movement and gamma. At the money option have a delta of 0.5 but gamma is highest. So if you expect the market to correct on the day of expiry and you buy at the money put option to play this move, and if your views turn accurate, gamma would ensure that you are rewarded spectacularly because the gamma is highest at the money. But the same gamma will cut deep holes in your pocket if the market moves against your view. So you will take big losses in case that at the money put option turns unfavorably for you. Hence, strict and disciplined stop losses are critical with this expiry day strategy. I have finished. Any questions, please?